It's not very often for a tax panel that we see an overflow crowd like this, so this is very exciting. We appreciate it. And welcome everybody to the SelectUSA conference and this panel on tax incentives and credits. As many people know, the U.S. government offers a lot of generous programs in order to invite investment into this country, to help companies establish themselves, as well as to develop and grow once they're here. The catch to all of that, if there is a catch, is sometimes these programs can be complicated. It can be difficult sometimes to identify which are the best programs, as well as which programs have deadlines, which programs might conflict with one another. And so we've got this panel here to discuss programs both on the federal and on the local level, to talk about how to identify those programs, what programs are new, what programs are popular, and then the logistics of those programs, how they can complement one another, and how you can go through the process of making the most of the programs that are out there. So we have a distinguished panel here to represent both the federal and local side, to give you a flavor of what's available across the whole country. Our panel includes Mr. Matt Abraham, who is a principal with Clifton Larson in their federal tax program. We have Michael Bernier, who is a partner at E&Y in the national tax practice. We have Brian Sabina, who is with the New Jersey Economic Development Authority. And we have Robert Van Geons, who is with the Fayetteville Cumberland Economic Development Corporation. So I will let each of them take a minute or two to introduce themselves, and then we'll move forward with the fun. So we'll start with Robert.
Well, thank you. It's a pleasure to be here, and thank you for such a wonderful turnout. Again, I'm Robert Van Geons with the Fayetteville Cumberland Economic Development Corporation, and on this panel, I represent me and my 1,000 or so peers across the United States who serve as the local contact for economic development. We often work on the ground floor, coordinating local, state, and federal programs, incentives, workforce development, and site selection. Fayetteville, North Carolina is halfway between here and Jacksonville, Florida, and we're also a proud home of Fort Bragg, which is the world's largest military installation by population.
Phenomenal. So my name is Brian Sabina. I am a Senior Vice President for Economic Transformation at the New Jersey Economic Development Authority. That means, it's a fancy way of saying I help lead a lot of Governor Murphy's innovation agenda. I manage all of our entrepreneurship, innovation-related tax credit programs, as well as have been working on creating a new package of tax credit programs for the state of New Jersey. New Jersey Economic Development Authority is the state agency that manages all the state's tax credit programs, as well as manages small business lending, strategic sector support, conduit bond issuing, and such. Very excited to be here and share a little bit from the state perspective of how state-based programs fit into the local and the federal landscape.
Great. Morning, it's Matt Abraham from CLA. I'm a principal in the Federal Tax Strategies Group, and I'm very excited to be here. As got some counterparts on the state side, I'm on the federal. And so I've been with CLA for a little over about a year and a half, and prior to that, I was with 2 other large accounting firms, and have about 15 plus years of experience in the federal credits and incentives area. So hoping to share some knowledge with you guys and get to know some other things from a state perspective.
Mike Bernier, I'm a partner in our firm's national tax practice. I focus mostly on opportunity zones and new market tax credits, helping our clients get those federal incentives. And I also work closely with my colleagues that handle more of the discretionary side, both across the U.S. and companies coming into the United States.
Well, thanks very much, guys. As many of you know, there have been a lot of changes, significant changes with U.S. tax law in the last couple of years. A little minor thing called tax reform came through. And before that, there were a few other fairly significant changes that had happened leading up to that at the end of 2015. So I'd like to talk a little bit now about the federal side, specifically what's new, what's changed, what's popular, And from there, we'll talk about some local programs that might complement those federal programs and what might have changed on the local side as well. So why don't we start with you, Mike? New tax law, tax reform, things like bonus or accelerated depreciation, opportunity zones. Why don't you talk a little bit about the opportunities there?
Sure. I think before you go into any specific program, it's helpful to think about how all the programs fit together, right? Because all of this is a package. If you think of the programs as a spectrum, there is what we call credit or program of right, and that would be something like the opportunity zone, the R&D credit, where if you meet all of the criteria, then you're entitled to the credit. There's no limit on how many people can claim it, how much you can claim, et cetera. It's just if you check all the boxes, you qualify. And therefore, with those programs, you have to be very careful because it's all about checking all of those boxes, right? And there's no flexibility for my project's slightly different, I need something else. It's you either meet it or you don't. And then you move to sort of statutory programs with some discretionary aspects. And that would be something like the New Market Tax Credit Program, where there are some rules you have to meet to qualify. They tend to be broader and less detailed. And then people will go through, and there's a process whereby you have to be selected. So there's a limited pool of funds. They go through and will pick your project. And then at the very far end of the spectrum is what I'll call completely discretionary. And that's something where there is really very few guidelines. It may be something very high level like job creation in this community. And they can go through and help create the package that makes sense for you. And as you're going through this, you want to think of how all of these different pieces fit together to give you the best package for your project. I think at the federal level, one of the big items that was very hot coming out of tax reform was the Opportunity Zone program. And what that does is if you're investing into a qualified opportunity zone, which there's about 11% of the country is an opportunity zone, and the states picked opportunity zones that are looking to be developed, so likely where you would place your facility, then the investor into your project, if your project qualifies, and again, credit of right program, so there's lots of criteria, 270 pages of regulations you gotta weed your way through, they get to defer the taxes that they owe on capital gains, and if you hold for 10 years, they pay no gain on the tax when they sell their investment, right? So it's very lucrative and very beneficial and a great way to raise money. More on another program we see is the bonus expensing, where people are going to go through and you get to deduct all of the cost of your CapEx if it meets certain criteria in the first year. And that has a huge benefit in the fact that it will mean that you're not paying taxes right away. And you'll generate typically a net operating loss, which you can carry forward and use in future years. So it gives you some period of time to ramp up your business before you have to start paying federal taxes.
Thanks, Mike. One that's near and dear to my heart related to, with some changes related to tax reform is the federal R&D tax credit program. I lead BDO's Northeast practice as well as our global R&D practice. So I love talking about this, and I could talk for 2-3 hours about this, but I'm not going to subject you to that. Matt, in looking at tax reform and looking at the R&D tax credit program, which is one of the most used programs in this country, what changes do you see there? And then another program related to that, in a sense complementary to that, is the work opportunity tax credit. So if you could talk a little bit about those two.
Sure. With respect to the R&D tax credit, when we were looking at tax reform, a lot of provisions were considered to be on the chopping block because the U.S. corporate rate went from 35% to 21% to be more competitive on the global landscape. And an intangible benefit that came about from an R&D perspective is the R&D credit survived. It became permanent in 2015 through some legislation, but there was some added benefit with corporate tax reform. So there's a provision in when you do an R&D credit calculation in the U.S., excuse me, where you calculate a net credit, and that always was a haircut at the corporate tax rate of 35%. So if you had a $100 gross credit, your net credit would be 65% of that because of the 35% haircut. Well, now that was basically a substitution of the corporate tax rate. And so when the corporate tax rate went from 35 to 21%, now your haircut, instead of at 65, 100 times 0.79. So right now, 100 times 0.21, so you get a $79 credit. So your actual credit went up roughly 21%. because of the corporate tax rate going down. So generally speaking, there's a small nuance in a provision of the code called 174, which is still not been ironed out, where there's legislation from the American Institute of CPAs of trying to change that to keep the existing law in place. But generally speaking, from an R&D perspective, it has been really favorable. And the credit was instituted in 1981, and it's morphed over the years. And it's surprising, as Jonathan, I spent a fair amount of time of the R&D credit consulting with clients, how many companies out there are truly eligible for R&D. Because most people think of R&D, they think of somebody in a white lab coat and goggles. But the tax definition for R&D is much broad-based. So if you're doing something as simple as software development, which everybody seems to be developing an app these days, you can potentially qualify for the R&D credit. There's another favorable aspect that was not tied to tax reform, but maybe a couple of years before. Generally speaking, in the US, if you want to claim an R&D tax credit, you have to be paying federal income tax. Well, they saw, a lot of startups basically not in that position to pay federal income tax, but they said if you're paying employer portion of payroll tax and you can calculate an R&D credit, you can take the R&D credit and offset it against payroll tax. So you could be in a loss position, which is a really good incentive because, let's be honest, right? Most startups are not making money and they're not paying federal income tax.
They're doing exactly what we want them to be doing, which is investing in their people, their products, actually building a business. So it makes a lot of sense to give those companies money at that stage to help scale their growth.
Exactly. And there's criteria where, it can't be, making a ton of money and you have to have no gross receipts, but there's nuances. But generally speaking, it's, probably once a month I will come across another company that can benefit from this. So, let Jonathan, the R&D credit is kind of near and dear to my heart, and I always try to talk to as many, individuals out there saying, hey, this is something you should consider because a lot of times, companies are leaving money on the table.
And something, just a quick thing to add to that, to Matt's point about a lot of companies don't realize that they're doing eligible work. We see that even more so with foreign companies who are investing into the United States, because when you look at R&D incentives around the world, if you recognize what is eligible in India, it's probably eligible in the UK, it's eligible in Australia, it's eligible in South Africa, it's eligible wherever you may guess it might be eligible, because the rules are fairly similar everywhere, except in the United States. In terms of the actual activities for them to be eligible, the bar is significantly lower in the United States in terms of what you have to be doing to qualify. So there's a lot of companies who are well-established international companies looking to invest in the United States, and they may think they're not doing eligible activity in the United States because they may not be doing it in Ireland or the UK. But that activity very likely could be eligible in the United States.
And one of the nice things from the state side, a lot of states allow you to layer that. So that New Jersey has its own R&D tax credit, which mirrors the federal program, so it makes it easy to use. But then you're able to apply that against your state tax. And then for those same companies, you mentioned those early stage startup companies, we have programs where you can actually sell net operating losses and sell those and turn it from a loss in your company into non-dilutive cash early. So those sorts of programs we think really closely around how do we look at what's happening at the federal level and then create stacked wins for companies at the state level.
Yeah, in essence, double dip opportunities, and depending on the state, for instance, in Connecticut, which has 2 credits, you can get into triple dips, and it can be a very valuable opportunity for you. But Brian, since you've jumped in on the R&D credits, are there any other state and local incentives that you want to focus on?
Yeah, so I think I would start by saying if we think that, I went on the SelectUSA website last night and looked at all of the different tax credits, and I think there were 75 plus federal tax credits. That's complicated. Now multiply that by 50 states, and that's what you have for state tax credit programs. I like to think about them by breaking them into category about what are they trying to do. So as you start to look at different states, I think about 1, we have jobs-based incentive programs. 2, we have place-based incentive programs that are really about how do we create a specific project in a specific place. 3, we have sector-based incentive programs, and there's overlap at the federal level there as well. Then I think we have 2 types of entrepreneurship types of credits. We have what I'll call innovation economy credits, and then we have what I call Main Street entrepreneurship types of credits. And then there's kind of all sorts of workforce programs and additional support there. So there's quite a spectrum of different types of programs based on different types of outcomes that we're looking to have. A couple of places where there's a really high overlap at the federal level, we mentioned the R&D tax credit is a big area. Two is around opportunity zones. So within states, I think you're seeing the idea of new market tax credit areas, of which opportunity zones are about 1/5 of those, becoming the real access or geographic access that a lot of states are organizing around. So for all of New Jersey's new programs, we're using those new market tax credit areas and those opportunity zones as a core geographic basis as we're thinking about differential investment. So if you're locating a project in an opportunity zone, you're going to get more bonuses in a lot of these programs. And that's, again, this idea of creating stacked wins for companies. In addition, I think you're seeing a lot of localities creating support programs around some of the federal programs. So, okay, we have an opportunity zone tax credit, but now at New Jersey, we're saying, how do we create transparency around where those opportunities are for investors? So we've launched what's called our Opportunity Zone Navigator, kind of a map that shows you where are the opportunity zones, what are the assets in them. We've created an opportunity zone marketplace where you can post projects. We're creating technical assistance grants for local communities to be ready. So all of those are kind of tools that we use where we take a federal program, and now we're starting to stack to make sure we get consistent wins.
So, Robert, in the Fayetteville area, as well as if you can look at, let's call it the national local view of things. Sure. What are you seeing in terms of opportunities that are new or you'd like to highlight, as well as any trends that you might be seeing in how these programs are being used or administered?
Well, and for all those who can't see me, hi. This is the face associated with the voice. No, I think touching on something there, we do have a national set of programs, and I think we've already discussed within those, there are lanes of opportunity. Take it down to the state level, and there are typically programs that apply across a variety of areas. But for the group here, I will say first that there is somebody like me in every community you're looking at who's there to help, before I tell you that one of your challenges is that every community can be a little bit different. And that's a good thing when you find the right relationship, which is what we ultimately want to build. But it's also, for example, we've talked about tax credits. On the national level, they mean one thing. In some cases, they are tax avoidance, if you will, a reduction in your liability. In others, they can be monetized and sold to somebody else utilize them. New Jersey's program is even unique in a way that if it turns into a loss, it can be, in essence, a grant, if you will, to the company. So unfortunately, common terms are not always interchangeable. But what we're seeing and what this all comes down to is there is likely something out there to support every component of your project, from extending infrastructure to R&D tax credits. And what we're seeing is a lot of creativity, whether it's working with a university or a college. Maybe I can't help you pay your rent, but I can build you a building. Maybe I can't pay for your equipment, but I can buy it with my university and create a training lab and an opportunity around that. Or your investment in that partnership can result in a taxable benefit for you as well. And so it's that level of creativity. I think the biggest thing is to open yourself up to discussing what the true drivers are for your project. Is it location? Is it workforce? Is it access to talent and markets? And that's where we start to shape this, because I think what you'll find is there is no one program that will cover your needs, but there are many, many small programs that can be cobbled together and layered on top of each other. It's kind of like making the best dessert. It's when you put all the pieces together there.
So we've heard that there are a lot of different types of programs out there. There's a lot of opportunity out there, both on the federal and the state level. So as an investor who's considering coming into the United States, there can be a lot of questions. As Brian pointed out, we've got 75 federal programs, then you got 50 states with similar types of programs. So, Mike, what advice would you give to somebody who's looking to come into the United States in terms of how to start going about looking for a place to locate their business and identify the best opportunities?
Sure. I think as we're advising clients in that space, there's three things we always want the client to keep in mind, right? First is that incentives shouldn't drive where you go. They're helpful, but you're going to have a facility, you're going to have a business there, you're going to have to operate that, and you're going to be hopefully operating that for 10, 20, 30 years, right? And so it's just one piece of the puzzle. And so we work with our clients to model out what it is, because you may get a nice credit from state A, but if their tax rate is higher, are you really paying more tax over the life of the project? If they may have access to employees, but if the wages there are higher, how does that affect your business, right? And so you need to look through all of that spectrum and map that out. And that becomes an important part because it helps you levelize it. We get clients that get sucked into, but this is a bigger package. Well, great, they're giving you more money, but some of that money is a tax abatement for property taxes that this state doesn't even charge you. So that needs to be considered. The other side of it, that kind of next piece of advice is go there with specific, reasonable, and justifiable asks, right? So when you show up at whether it's the governor's office, whether it's some of my colleagues on this panel, you want to go and say, hey, this is what I need, and you want to be asking for stuff that you have an idea that they've given before, right? Because if you're saying, hey, create this brand new, entirely different program for me, that's a tough hill to climb. So you want to make sure it's a reasonable ask, and then you want to make sure it's justifiable, right? And so we spend a lot of time doing economic studies for our clients. What's the benefit that they're getting, right? Because it's not just what you want, right? It's a partnership. And so I'm going to say, I want you to give me this. Here is what I'm giving you back. And just saying it's 100 jobs is not usually sufficient to get them to open up the wallet the way you would like. And so you need to sort of say, hey, here's what the jobs are, here's the salary, here's the wage impact, here's all the economic impact that you're going to benefit, and here's what I need to get across the finish line. And I think if you can keep that in mind of, not letting the incentives drive everything, modeling out the entire package and the entire cost, and then end with what are you giving them so you can negotiate a fair and reasonable package, you'll be in very good shape. I think if you miss one of those three, it can be a very tough road.
Can I add on that from the other side? Somebody who sits on the other side of the table, 100% agree that if you start thinking about strategy first, strategy is going to trump the strategic aspect of your project is going to trump the incentives every day of the week. I do want to push and say we should be thinking about value and not just cost. Right, so because that increased labor cost may come with a bump in productivity, right? So whenever we talk with companies, we try to orient the conversation around what are you getting and how do the tax incentives play into a value equation and not just a cost equation in this decision making. The last thing I would say is companies who come, so agree that you need to ask within the boundaries of programs and especially within your decision-making time frame. It's hard for authority to create a bespoke program for many localities. But companies that come and say, here's what I want to do. I want to grow this business. I want these outcomes as opposed to I want this dollar amount, but I want to work with you and partner with you to have this outcome. I think you'll find a much different reception on the state side or on the local side. I think our minds open up, our eyes open up and say, how do we work with you to make this happen? Because it may be a bespoke talent partnership where we work with our local community college or work with our research university to create a talent pipeline for you that is actually going to drive the most value in addition to using some of our current incentive programs.
And Robert. I think that touches on a good point. It's not a question often of desire to assist. There are limits on flexibility in a statutorial sense, in a legal sense, that at certain federal programs, they just don't have those options. The state, there may be some. At the locals, we often have the greatest flexibility, but also the least resources available. But the one thing I would say around this is, if you are interested in a project and you want to go down this road, start asking questions early, and it is never too early. I tell my companies all the time, there is almost nothing we can't accomplish if it's reasonable and rational with enough lead time. There's often very little I can do to help if it's after the fact. And so we often run into that companies will say to me, well, we just didn't feel we had enough information to start the conversation. You have plenty of information if you're looking at a project in the U.S. to begin to talk about it. On the flip side of that, across this table here, we will all tell you that we are happy to run scenarios, especially at the local level, but there's also going to be inputs that we have to give you definitive answers. We want to build a relationship. We want to build a long-term one. We want to do a project today and 5 years from now and 15 and 20 years from now. So we can start the conversation, respond, but we do need good inputs to give you a firm answer on what can be accomplished as well. It's a balancing act.
And that's because you're
information.
modeling it out, right? So on your side, you're looking and saying, what am I going to get from it? And you want to, if you're going to them, have a model and have some idea of what they're getting out of the other side, right? The more information you have in the negotiation and the more you sort of understand, the easier it is to get to a win-win situation, where if you only have, here's what I want, and you don't know what you're giving them, or you don't know how they're valuing what you're giving them, then it becomes much harder to find what's the reasonable outcome.
Yeah, and I would also,
So Matt, in terms of this, we've mentioned 75 federal programs. You've heard about the perspective from Fayetteville and New Jersey at this point. If you've got a company coming into the United States, investing into the United States, how do they begin to narrow it down so that they know, number one, what programs might be applicable to them, and number two, do they talk to Robert and Matt, or do they talk to Susan and Jane, or do they talk to, how do they narrow down the search so that they're looking at, say, 5 or 10 potential opportunities or areas that they want to go into, as opposed to any one of the more than, believe it or not, 10,000 taxing jurisdictions in the United States?
yeah, no, that's a good question. I think it's, as I heard a couple of my panelists say, this should not be tax motivated, but you want to think about everything holistically and how are you going to approach landing, on U.S. soil. What are you going to do from a strategic standpoint? And not to be biased, but I always think you should get your accounting firm involved. A lot of times, they will talk to your attorneys and they will do structuring, and sometimes that structuring might lock you into an entity structure that it's hard to unwind. So I think it's really important to talk to your tax and accounting advisors to figure out, okay, hey, do you have how many offices do you have in the U.S.? So do you touch how many states? And based on that, hey, we were thinking of setting up shop in New York because from a travel standpoint, it's easier to come from the UK straight to New York, right? So you'll think about it from a state perspective and logistics. But I think it's really important to talk to your tax and accounting advisors to get their understanding of the lay of the land as to, here's what I'm thinking in setting up my corporation in the US. What kind of tax benefits should I consider? And if I don't plan ahead, am I leaving money on the table? There are options of amending prior year tax returns, but sometimes that becomes a hassle. You want to try to do as much stuff in real time. And the other thing I would comment, to just talk to my colleagues on the left here, the local level, they're really, this is what they do day in and day out, and trying to incentivize companies so they can grow their local economies and attract, individuals from state to state and from foreign countries. So I think those two are the ways to kind of look at it to ensure that you're properly.
And if I could plug my private sector peers on the panel, beyond the tax liability, your drivers of whether it's customers or workforce or suppliers or logistics should play a very large role in narrowing down those acceptable areas. And if you don't have that information on where that should be, these three guys here all have great partners that can help you with that in looking at that other side of this model. We're talking about how you make a viable project better, more profitable, or maybe get it over a line from being a yes versus a maybe. But at the end of the day, it'll be the larger market dynamics that drive your viability.
And I think the viable project is the key, right? Because the way this panel is, we jumped into credits and incentives and here's the different benefits. But when we're working with our clients, and whoever you're working with should be doing this, is you don't start and say, hey, I want to go to Fayetteville because they have this state program. You start with, here is the locations that have the things I need. What is the acreage? What is it? Do I need rail? Do I need access to airports? What are all the things that I need? Now you're going to come down to some smaller set, maybe it's a dozen or something like that. Now you can start working through what programs are out there, how do I sort of narrow it down, how do I start talking to people, but always start with what are the key things the facility needs and where is that available?
Yeah. And I will also say, going from, one way to quickly narrow down is if you kind of generally know where in the country you want to be for strategic reasons, go and talk to the state. Often we'll have a very good sense of, here are where companies like yours, here's where they're going, here's where they are today, what's important to you. If this sort of aspect is important to you, here's some locations that could be a value. And we'll also be able to connect you into some local partners who can accelerate your decision making and information gathering much more quickly. So we have a nonprofit partner called Choose New Jersey that does a tremendous amount of services for inbound companies who are looking at New Jersey. I know a lot of other states have those services as well, and they can help you look across a wider swath of opportunities and narrow those down.
So before we jump into the practical side of things, the how do I get these incentives, how do I file for them, how are they administered, that type of information. Are there any programs in the last couple of years that have really jumped out in terms of they're now considerably more popular than they used to be? Are there any that used to be very popular that are less popular now? On the federal side, Mike, are you seeing anything there?
On the federal side, I think it's really parsing through, right? So opportunity zones is something you're going to hear about all the time, and it's in the press, the business press, the personal finance press. I'm sure you will hear opportunity zones 1,000 times over the course of this conference. As somebody that advises clients on that may or may not be the right fit for you, right? So again, that's one consideration. Is this in an opportunity zone? Is it not? But I would encourage you not to sort of chase the hot program, and I probably should be telling you to chase the programs that we help with, but don't chase the hot programs. Go forward and sort of figure out what's the best site. So we were working with a client that was looking to build a manufacturing facility, and the client was all about opportunity zones, and it's how I'm going to raise my capital, and here's 3 sites that are opportunity zone eligible. And as we started going through that, what we found out is those weren't the best sites for them. There was actually 2 sites that were a much better fit for everything else. When you look at the complete package, you look at the logistics, and you go forward, and they're choosing between those 2 sites, which aren't in an opportunity zone. So I would say really think of it holistically and don't chase the program, but the hot program, to answer the question, is opportunity zones at the moment.
And Matt, a lot of the investment that goes in a lot of these programs that go in are driven by job creation.
Correct.
Can you talk a little bit about the work opportunity tax credit?
Sure. And this is something that, cast a wide net on who could qualify. Or the work opportunity tax credit, Wattsy, basically it's a point of hire tax credit. And it basically offsets the costs for companies when they hire employees. And if they're in certain targeted categories, for example, if they're long-term unemployment recipients, if they're a qualified veteran, if they're in a certain designated zone, empowerment zone, and even surprisingly, you can hire a qualified felon and still receive a credit for anywhere from $2,400 to $9,600. And the criteria, the hurdle to achieve that is pretty low. These individuals have to be employed for a minimum 120 hours over a 12-month period in the first year of employment. And it applies to pretty much any employee. Oftentimes you see low-skilled employees because that's where you see the more turnover, right? If you hire somebody in an office job, there's a higher likelihood they're going to stay there for a longer time. But if someone in the restaurant industry or a manufacturing sense, they might stay there for 3 months and then leave, then you'll fire a replacement employee. So employee A, you might get that Wattsy credit, and employee B, who filled that person's role, you can get the Wattsy credit. It applies to seasonal employees, part-time, full-time. They just happen to be, have not been hired by that company before. So there's a lot of incentive, and you think about it, anytime you have a workforce when you start in the U.S., you are going to need employees. So this goes back to talking to your tax and accounting advisors and saying, hey, what are there from a jobs credit perspective? There's stuff at the local and state level, but there's also this thing at a federal level, which I find is really intriguing and helps out a lot of companies.
And we certainly build off those same programs. That's another example of where you can get a stacked win In New Jersey, we have similar types of programs for returning citizens, for folks who are in certain demographic groups that we're looking to make sure they have opportunity. I think across the country, you're seeing a lot more states focus on how do you get to an outcome of a good middle-class job as opposed to just focusing on, I just want the highest paid jobs, right? So I think we are valuing a spectrum of opportunities that companies are bringing to us and not just looking for the $100,000 R&D job. Of course, we want that as well. But if we can get middle-class, middle-skill jobs, we're pretty excited about that right now.
Yeah, the good thing about Wattsy is, it goes into a certain designated, like if you're getting government assistance, it basically, we're 10 years past the Great Recession, but there's still a lot of people on the government's payroll. And so this is their way of saying, hey, private sector, if you can hire these people and we don't have to pay them through our coffers, that's really going to be a real benefit for the whole economy.
I think we've also seen an uptick in interest in foreign trade zones and the benefits they provide from a taxable perspective on the goods coming in, processed, and then leaving the U.S. As we continue to see that increase in international trade with multiple nations and some shifting dynamics. And I think then the push towards cost avoidance as much as tax credits, whether it's providing paid for customized training or carrying workers into employment. Many states have pushed down their corporate income tax rates, so there's not as much there to work with, which is a good thing for the taxpayer. But at the same time, it's made states and localities more creative in doing things on the front end or avoiding cost for the companies.
Cost avoidance is a big thing, right? So take utilities. The United States, you'll see utility rates are dramatically different from areas, right? You can find retail utility rates as cheap as 4 or 5 cents a kilowatt hour in some places, and they can be north of 20 cents in other places. So if you're going to build a facility that's going to use a ton of electricity, then that needs to be a cost avoidance consideration along with the different incentives you're getting.
So we've heard a lot about what incentives are out there. Let's talk a little bit about logistics and administration. The last thing that we want to see is have a company be excited about coming to the United States, investing in a new facility in the United States, hiring a lot of people, and then realizing that they've missed a deadline and they're not going to get that incentive. So for most of these programs that we've talked about now, and each of you can talk about a couple of them as you go through, in terms of the actual application process, is this something that is an application that's filed by a certain deadline? Is this something that's filed with tax returns? Is this something that if you're not getting the full incentive, you can carry forward or carry back? Or is it use it or lose it type of situation? Starting with Robert.
Yes, and that's why, and I'm sure my colleagues will talk on the individuals. If you're going to, and it is worthwhile to explore every opportunity, you need to build a long-term strategy for managing and applying, because all that you listed likely can occur for every project. On the local level, it may be as simple as a conversation and then a grant document and paying your local property tax. On the state level, there can be annual compliance and a form that could take a few months to work through process depending on the size of the project. On the federal level, it's tied to your tax return. So I think this is where, as someone who every day wants to say, what can I do to help the companies in my community, I get heartsick working with someone to build an initial package, and then through transition, the person that negotiates it does not manage the project. The person that manages and implements the project does not do the compliance. And so you see often 3, 5, 7 years out, a lot has been left behind despite us trying to actually proactively help companies take what is rightfully they've qualified for. So not without the specifics to say you must have a strategy for ongoing compliance and tracking of this, whether it's through good professional help or internally, and there'll be resources that need to be committed to that.
Now, Matt, more specifically on the credit side of things, or the federal side of things, when it comes to R&D credits, Wattsy, same question to you.
Yeah, from a federal perspective, it's all kind of initiated through the filing of the federal income tax return. You'd like to do it in real time and not amend your return, but the U.S. gives you the opportunity. If you have a return that you need to amend, you can go back to your 3 open tax years. to file amended return to get those claims through via a refund. So that is available to you. So, I'm working with a company that's based in Denmark and has U.S. operations in Northern Virginia, and they have 1,000 some engineers. They're eligible from an R&D perspective. And from a UK perspective, they've been claiming a credit for a while, but nothing from a US perspective. So here's a great incentive. We would never leave that kind of money on the table, and we would go back and amend your prior year returns to capture that federal credit.
And I think with the federal, one thing that we see a lot of is people come to us at the end of the year when they're ready to file their tax return. And then there's a conversation of, oh, you were eligible for this credit. Now you're trying to go back and recapture all the information that you needed, right? So I think even for programs where you're just filing it with your return, collecting that data is very important, right? So like with the Wattsy credit, one thing we see is if we can collect information at the point of hire, and we can do it in a system that increases the amount of people that will respond to the survey and give us the information we need, we can help maximize that credit, right? And you can't wait till the end of the year. I mean, you can, but now if I'm going back and trying to find all the people, maybe somebody worked for me for 3 months, has left a job, I'm never getting that person's information because they're not going to give it to me. So there is a lot of planning even with things that are on the federal side, and that can really help you maximize the benefit you're taking.
And it's not always as simple as just amending. There are certain elections that have to be timely. Do you want to talk a little bit about those, the things that you can't go back and change your mind about?
So there are certain programs where you're going to be locked in. So for example, the one I'll use here is the Opportunity Zone program, because that's the new area. For that, there's very specific timing requirements. So when the investor is going to roll their gain over, in order to be eligible, they have 180 days from the date of sale or 180 days from the date the gain came through on the K-1. That's not when they receive the K-1, that's when the K-1 is sort of official, which is the last day of the tax year. Then the fund has a certain time requirements to spend the money, right? And that's where if you miss it by even 1 day, you're out of luck. Then the business has 31 months from when it gets the money from the fund to deploy the money and start meeting the various criteria. So that's a good example where you have all of these very sort of concrete deadlines that you need to make sure that you don't miss a single one. Because if you miss the 180 days by 1 day, and we've had a client that did that, they didn't wire the money in on time, you're out of the program sort of forever, at least for that gain.
So you have to be very careful about some of these things in terms of, number one, through the application process to make sure that you're checking all the boxes so that you're going to get the incentive coming to you. But then the next part of this is, once you've filed the application and once you've got the incentive coming in, what are the compliance requirements in terms of going forward for, number one, continuing to get that incentive, or number two, being prepared if, say, it's a federal program and the IRS decides they're going to take a look at it on an audit?
So I think that's a lot of tracking. And so what Robert was getting at is needing to follow this, because one thing we see is exactly what he said. People go out, they'll get it. So the tax department may say, hey, we're eligible for this credit. They tell some people, and then they say, hey, it's off of my plate. And how are all of these things going together? So one thing that we have is a tool that we use with our clients where you can upload all of the different incentives, all of the different deadlines, and it almost becomes like calendar reminders. Okay, you need to send this to Robert by this date. You need to have this information or you're going to lose your benefit, because it's not uncommon for us to see clients get a very large package and then through not following all of the criteria, not following through with the hiring, not filing all the paperwork, to see that package chipped away and they walk away with, half of it or less, right? And so it becomes really important to make sure you're following through and you have that, I'll call it the process in place, because what's going to happen is it's going to be very different from program to program, right? The compliance aspect of Wattsy is going to be very different than the compliance aspect of New Markets Tax Credits, and very different than maybe a pilot that you negotiate with my colleagues on the left.
Yeah. So, for example, with the R&D credit, federally at least, can be carried forward up to 20 years, which means that if you're going to use it 20 years from now, because you hadn't used it in the prior 19 years, the IRS could choose to look at your support for it 20 years from now. So with that in mind, Matt, what advice do you give to investors coming into this country in terms of documentation systems in order to maintain the evidence of their eligibility?
Yeah, no, that's a great question. This is something that whenever, we go into and helping companies from an R&D credit perspective, companies, the employees always ask, well, how burdensome is this going to be on me, right? I've hired my tax manager, controller, CFO to spend X amount of time doing outside of activities. You're great, you're helping with a credit, it's going to help my company. But we try to make sure that, hey, we'll take on that burden, but we still need you guys engaged, your employees engaged, so you can kind of feed that information. And oftentimes people say, hey, you know what, that's great, but I don't know if I want that extra cost. But then you tell them, if you've got a lead engineer who's been working on a program that's going to be R&D eligible, and 5 years down the road, that lead engineer is no longer around, how are you going to get that institutional knowledge that you need to document and substantiate the credit? So if you can kind of do that in real time, that helps tremendously. As Johnson said, they can come back down the road and say, hey, we want to look at what, 1998 or 2008, and you're like, I don't know who was there, I don't know what project we worked on. And so, say it's the CFO that took on the role recently. Now he or she is scrambling to try to recreate something that they had no involvement in. So it's always good when you're coming and doing something in real time. And my colleagues on the right are pretty good. We operate in the same space where we try to minimize the amount of time commitment on your guys' end, so you guys can take advantage of these federal credits, but also feel comfortable that you can go to sleep at night, and then if it gets challenged by the IRS or a State Department authority, we will have a good case file to kind of walk them through to make sure that, hey, at the end of the day, you're claiming what you truly should be claiming. So I would encourage just doing real-time documentation.
And I would add, this really is fundamentally a deal between the public and private sector, where what the public sector is getting is a set of jobs, a set of investment. And there is, a fairly large mega trend across the globe around transparency and pushing for transparency and pushing for, within the incentive world, pay for performance. So I think you're going to continue to see, certainly the state and the local side, a need to realize up front that there are costs associated with monitoring and keeping yourself accountable through these programs. And that I expect from the state and the local side, that's not going to go away anytime soon, right? I think it's only going to stay where it is or get a little bit more in terms of making sure that companies are achieving the milestones that they're committing to.
I would say, just as we touched earlier on, that an incentive or a grant can sometimes be not about what you get, but what you never had to give from a cost perspective. You also, as you evaluate your total project, there are opportunities to do things in phases. Today, you may not be the right day to commit that long to a level of compliance. Getting to the point of also asking, is $1 million today, with 20 years of compliance and or regulatory work or risk on the side of ensuring your compliance, as valuable as, say, $500,000 today with 2 years and limited levels of commitment? So there is a balancing act on your end as well as looking what that investment is. The old adage of nothing is free remains true, whether it's access to data, a liability for compliance, or a timeline, or the people you allocate to tracking that. There is going to be an investment on both sides of that equation.
So we've learned a lot today. A lot of great insight in terms of programs on both the federal and the local level, and how to go about identifying those programs and then actually applying for and getting the benefit of those programs. In closing, and I'll run across the panel on this, what are some of the common mistakes or pitfalls that you see, things that should be avoided that come up more often than you'd like to see? Starting with Robert, and we'll come this way.
I would say that, and we've touched on some of those here today, it is often the question that went unasked that is the problem down the line. That we missed an opportunity where we could have taken advantage of something, where we missed a clarity on when certain materials were. And so, again, I'd come back to ask early, ask often. Don't ask for everything, but be willing to ask about everything. If there is an idea you have and a willingness to partner, there's probably a way that we can do something to support that. But I would also just say, at the end of the day, we have these resources because we want you to be successful. But we can only respond as well as we're engaged with the information we receive. And so it's that open and honest and long-term visioning conversation where we can be most effective.
Matt.
So that was an excellent answer. What am I going to say now? No, I echo one. Come talk to us early. There's just a tremendous amount of variability in all the programs. We're here to work with you and help you navigate all of that complexity and help find the best outcome for you and your business. That's what our job is. So please do come and talk to us early, and we can help you through the process. I think is one. And two is do take that long-term value-based orientation. Taking a cost reduction orientation or kind of a short-term orientation around your project often doesn't lead to the best outcome. So if you can take that long-term value orientation, leads to a better project and a better incentive.
Yeah, no, I would to reiterate those comments. Look at the long game and talk to your advisors early, because if you do that, you'll probably most likely be successful.
Yeah, I would remind you to map out what it costs, what the different costs are in different areas, what the different incentives are. How does that all sort of factor into the equation, so you know what you're asking for and what you need. And then also, it's a negotiation, right? So like any other negotiation, you're asking for something, you're giving something up. Make sure you know what you're giving up, and you can sort of articulate the benefit you're giving to the communities to sort of get the best offer. To me, that's the equivalent of saying what your product does. You would never walk in without being able to explain, this is why you should buy my product.
Thanks, Mike. And so we have a full house, and we've got a couple of minutes left. So does anybody have any questions for the panel? If you have any questions, there are mics along the middle there. And
Are we sure? Because there's always that one person, I'm that person, who goes, man, I wish I asked X. So throw it out there if it's out there. Or everybody just is really, really tired.
it's the first session of the day. They're excited. Well, thank you very much, everyone, and thank you to the panel.
Thank you.
Great, thank you.
Thank you all very much.